Hello once again. In today's video, I shall wrap up 2025 by showing you my performance this year and my outlook for 2026. As 2025 comes to a close, I would like to take this opportunity to thank our supporters. Your support encourages me to create valuable content for you guys and hopefully grow our community of like-minded STA clubbers who are keen to sharpen our investing skill sets by learning and sharing from one another. Do continue to share this channel with your family and friends. Hello everyone, welcome back to STA Club, the club for stock trading and analysis. This channel is dedicated to providing you with high quality tutorials, guides and insights that demystify the world of trading. Join us as we will share more trading secrets and valuable insights. To stay updated and to be the first to access these valuable resources, hit that subscribe button now. By subscribing, you're opening the door to a world of trading and maximizing your potential for success. Before we dive in, here's a quick disclaimer. The information in this video is for educational purposes only. It's not a call to buy or sell. In 2025, the S&P has been a tale of resilience through turbulence. While the bulls ultimately came out on the top, it was by no means a smooth ride. As of late December 2025, the index is on track to finish the year with a solid return of approximately 15% to 17%. Marking its third consecutive year of double-digit gains. The recent announcement of the US Q3 GDP coming in at an annualized 4.3% proved a strong hit, as it surpassed analyst estimates and expectations. Lower than expected inflation and a Federal Reserve easing cycle provided further fuel for the market to reach fresh record highs in late December. The bulls seem to have forgotten the sudden tariff announcements in early April that caused a bear scare where the S&P 500 plummeted over 10% in just 2 days, wiping out trillions in market value. I will now show you how my portfolio has performed since the inception of my investment fund and the lessons that could be learned in 2025 from my investment mistakes. Let me first take you through my current portfolio composition. My portfolio currently consists of 37% in stocks, 27% in bonds, and 35% in cash. Comparatively, Berkshire Hathaway, which is co-founded by Warren Buffett and Charlie Munger, currently holds 31% of their entire portfolio in cash. Most of my stock holdings are based in the US, while the remaining 32% is held in Singapore stocks and 8% in Australian stocks, respectively. My bond holdings are mostly held in 10-year Singapore government bonds. Here is the composition of my stock holdings that I currently own. The largest proportion in my portfolio comes from American Express and Apple. My top 3 best performing stocks since inception would be Google, of which I made a 258% return so far, American Express, of which I made a 160% return to date, and Apple, of which I made a 106% return respectively. In 2025, my entire stocks portfolio generated a weighted average 1-year return of 18%. You will notice that this was less than what I made in 2024 and 2023 respectively due to the market higher volatility in 2025 as stock prices found it harder to push upward from an already higher base. You would have noticed from my portfolio of stocks that all my investments are profitable. I have not made any losses in any of my stock investments so far, and I have to thank my lucky stars for it. But have I made any investment mistakes since the inception of my investment fund? Yes, of course. At the end of the day, we cannot always be right, especially when the market is always dynamic and ultra competitive. I purchased stocks in Kraft Heinz in 2023 and LVMH in 2024 and sold put options to accumulate the shares of these companies every time the price came down further. Kraft Heinz is in the business of food processing and LVMH is in the business of luxury retail. I knew that both were leaders and experts in their domain of business, and both stocks to me seemed undervalued. I thought that their undervaluation was due to their business experiencing a temporary downcycle, and that because of their domain expertise, they will soon recover when their downcycle recover. I was wrong. Year on year, I noted that in most of their business segments, revenue declined and that they were always doing poorer than their competition. The strategies that management put in place did not seem to work. My inner voice told me to give them another chance, and I did not sell out until I finally gave up early this year. I'm, however, thankful that I did not incur any loss when I sold both these stocks off. But this episode taught me a valuable lesson. That is, to be more careful when it comes to identifying undervalued businesses. A question I now ask myself is, if the business downcycle is actually temporary or permanent. This could help prevent myself from falling into something called a value trap, where something that appears to be attractive at the surface may not be when dug deeper. I have to admit that this is easier said than done, because as humans, we tend to have fallacies, and our emotions usually overcome our rational mind at times. So, how do I see the markets in 2026? And what will be my strategies be like in 2026? To see if the markets can continue to remain bullish in 2026, we have to first look at earnings season in the first quarter of 2026. Usually, the earnings season in the first quarter of 2026 would capture the holiday season, something we call window dressing, where businesses tend to do well as consumers spend more during the Christmas holiday season. However, if the opposite comes true, and that earnings come up poorer compared to the 2024 holiday season, then this would tell me that consumers could already be tightening their belts, and a continuation of these signs could lead to a further domino effect that would flow into other sectors of the US economy in 2026. As of today, I do think that most developed markets are too expensive to invest in, and that is the reason I'm currently holding a large portion of my portfolio in cash reserves. In 2026, I could still be looking at generating attractive yields from occasionally selling put options at times when I notice heavy market volatility. This could put my idle cash to good use, given that the current interest rate environment is weak. Being a value investor that focuses on crisis investing, I prefer to build up my war chest, and when the opportunity comes for me to go in big, I will go in bigger. With that, I wish the SDA community a happy 2026, and may you continue to develop your investing skill set and be a true intelligent investor in time to come. For more information on how you can optimize your portfolio and would like to seek advice on your current investment portfolio, speak to us by replying to the WhatsApp link in the description section below, and our team can provide a personal touch and talk to you about your investment plans. See you in my next video. Goodbye.